Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 25th year in business, soon to be 26. It's midday, Tuesday, December 23rd, and this week's audio blog, the last of the year, is titled 2014 Review and 2015 Predictions. Now, like last week, I'm writing this week's audio blog in installments, starting Monday morning, following yet another heinous cartel attack at their two favorite key attack times of 10 a.m. Eastern Standard Time and 12 p.m. Eastern Standard Time, as presaged by the oldest trick in their book, i.e., smashing the Huey mining index whilst gold prices were still strong, to signal their minions of an imminent paper raid. And this amidst yet another global economy killing oil price plunge. The CRB commodity index imploding to within 15% of its 2008 spike bottom low, with no end in sight, and horrific existing home sales data, which even the most biased central bank sympathizer knows will catalyze additional QE schemes in the near future. For that matter, the collapse in global economy is why Fed goosed interest rates around last week's FOMC statement to further expand the rate hikes in 2015 charade, were stopped cold in their tracks, with the benchmark 10-year yield capped by market forces at the 2.2% yield I wrote of 2 months back as having massive upside resistance. Plunging anew as I write, en route to the dreaded one handle in the coming weeks, or months, or even weeks. Comically, I read this morning that the hedge fund industry, which cumulatively is going the way of the dinosaur because it doesn't realize markets are rigged, is more short treasuries than at any time in the past 3 years. No doubt, sucked in hook, line, and sinker by the Fed's tapering lies, irrespective of the gargantuan market forces proving them wrong on a daily basis. Nothing will make me happier than watching the hedge bombs implode, as I deemed them 2 years ago, before the cataclysmic underperformance that has caused America's largest financial institutions to start shunning them. Back to the metals, if in fact the cartel is dumb enough to cause gold to end the year below $1,200 an ounce, let alone silver close to $15 an ounce, it will only serve to maximize the catastrophic write-offs of the precious metal mining industry, heightening expectations of what the Miles Franklin blog has predicted all along, i.e., utterly collapsing global production, likely on a permanent basis. But more on that in a moment. To that end, even I am awed by the obvious importance the powers that be attributed to painting markets in and around the FOMC meeting last week. In many ways, as aggressively as in November, when Western central banks clearly collaborated in epic, historic fashion to ensure the Save Our Swiss Gold referendum didn't pass. Off topic, slightly, the Swiss National Bank, led by Lady Macbeth Thomas Jordan, who doth protest too much of the need to hold gold, took but 3 weeks after the referendum's failure to initiate a negative interest rate policy, in effect slapping Swiss citizens in the face by first telling them how evil gold is, then devaluing the franc to its lowest level in years. And this, whilst the euro it is pegged to is on the verge of taking out its July 2012 whatever it takes lows. Trust me, loyal listeners, the SNB will be loudly called out in the coming years for having single-handedly destroyed history's most conservative, efficient financial stewardship. As for the FOMC meeting, which I described in detail in last week's laughable FOMC statement sets new central bank credibility low, what amazes me most in hindsight is how important the Fed's playbook has become, starting with the tapering scam in spring 2013, the so-called end of QE in October 2014, and purported commencement of, albeit minuscule, rate increases by mid-2015. It's almost as if they believe that keeping to this script will somehow justify their obvious goosing of the stock market, to the point that the MSM and Wall Street will literally write anything to rationalize it. To wit, the fact that not only the MSM, but even Zero Hedge, wrote of how the Fed took considerable time out of its statement last week, when in fact it didn't. Or the unending hype about holiday sales being strong, despite the utterly horrific Black Friday weekend results. Or the fact that, right under our noses, deep discounting is as blinding as a solar flare. I mean, The first thing you saw when you clicked on Amazon.com Sunday morning, i.e. America's largest online retailer, were 20 to 25% discounts on their flagship Kindle products, as well as free 2-day shipping across the board. And this from a company already in the red on an operating basis before the key holiday season even started. However, the MSM and Wall Street simply won't let the facts stop them from a good story, like this morning's fourth crude oil plunge in as many days, or the biggest single-month plunge in existing home sales in nearly 4 years. No, as long as the relentlessly PPT-supported stock market keeps rising, they think they can literally say anything. Such as Reuters, for example, which wrote Saturday afternoon that last U.S. holiday shopping weekend is off to a solid start, without even a shred of evidence other than to say malls were packed. Or CNBC hyping the fact that despite missing earnings expectations and lowering its profit forecast last week, FedEx maintained its expectation for the number of packages delivered. Well, duh, of course they're delivering a lot of packages, as between population growth and the dramatic increase in online versus brick and mortar store sales, of course they're shipping more packages. The only problem, of course, is the profitability of such shipments is plunging, let alone for retailers like Amazon offering free shipping of products that already have razor-thin margins, if at all, like $59 Kindles. And one more comment for anyone that still believes falling oil prices are a good thing for the economy. At today's WTI price of $55 a barrel, which by the way translates to roughly $45 a barrel for Bakken shale oil, and less than $40 a barrel for Canadian tar sands, nearly all U.S. shale wells are unprofitable, simply on a variable cost basis before all the capital expenditures they put into them. This weekend's comments from the Saudi oil minister only solidify the near certainty that OPEC's low-cost producers will maintain the price war on high-cost production the world round until every last shale producer is bankrupt, and with them, the $500 billion of junk bonds and leveraged loans and countless tens of billions of public and private equity that finance them. As Peter Schiff eloquently put it, the oil and housing price plunge of 2008 was theoretically good for consumers too, except for the tiny issue that it was far more bad. And now, per today's audio blog title, I'm going to discuss the 2014 predictions I made a year ago, as well as those I'm making for 2015. Not that my crystal ball is better than anyone else's. Well, from a macroeconomic standpoint, perhaps a bit better than average. However, given my Wall Street upbringing, this right of winter is as ingrained in my financial DNA as the spring harvest to a farmer or the Academy Awards to an actor. Of course, the key to making such predictions, from a marketing standpoint, has always been to highlight one's successes, whilst conveniently ignoring the failures. In my case, especially as I don't make financial recommendations, I'm happy to discuss all I predicted. In fact, much of it was spot on, and of the parts that weren't, for the most part, market manipulation was the principal reason. That said, only you can judge if what I said in sum total was closer to the truth than that of mainstream commentators and Wall Street cheerleaders, propagandists, and liars. Yet, irrespective of said manipulations, I believe my 2014 predictions were far closer to reality than the aforementioned shills. Okay, I have 10 2014 predictions to discuss, which I'll follow up with my 2015 expectations. So let's get going, starting with the first prediction I made a year ago, that, quote, worldwide interest rates would continue to rise, led by the United States. Yes, I got that one wrong, but have faith, it gets better. I mean, when I wrote 3.0%, enough said, in early January, it couldn't have been clearer the Fed was capping the 10-year Treasury yield at 3.0%, following China's late 2013 disclosure of massive Treasury bond sales, followed by the convenient emergence of Belgium to offset said sales with historic Treasury purchases at up to 80% of Belgium's GDP. However, when the global economy accelerated downward in the spring, the tables rapidly turned on the Fed's tapering scheme, with rates rapidly dropping despite their obvious efforts, via what I deemed the new Hail Mary trade, to prop rates back up. This is what I discussed in one of the most important articles I've ever written, May 7th's most damning proof yet of QE failure, i.e., plunging market rates despite the purported recovery and Fed tapering. This article was published, again, in early May, coincident with another titled 2.6% Enough Said, in which I noted the Fed's obvious desperate efforts to prevent the 10-year yield from falling below 2.6%. It was then that I started speaking of my steadfast belief that the entire Western world would start to realize QE to infinity was coming, and subsequently front-run central bank monetization efforts like the Fed's. Starting then, I predicted the 10-year rate would eventually fall to Japan-like levels well below 1%, which 7 months later I believe more than ever. Of course, when hyperinflation inevitably results from said QE to infinity, all bets are off regarding the direction of subsequent rate movements. Which brings me to 2014 prediction number 2, which at least partially offsets the degree of my being, quote, wrong about number 1, i.e., central banks will do whatever it takes to suppress rates, which they decidedly have, from the ECB's NERP and QE announcements, Japan's expansion of Abenomics, and even the Swiss National Bank's NERP announcement last week. And by NERP, I mean negative interest rate policy. Countless central banks have followed them to the depths of rate repression, including the People's Bank of China this fall, as the final currency war we wrote of 2 years ago accelerates dramatically. As for 2014 prediction number 3, I said Obamacare's initial economic impact will be devastating. And devastating it has been, despite the fact it hasn't been fully implemented yet. With the most devastating aspect by far, the mandatory employee health care mandate, having been delayed until 2016, presumably to prevent an even more gruesome result in the 2014 elections. Irrespective, employers from IBM to Walmart, to of course thousands of smaller employers, have been dramatically slashing the amount of full-time workers on their payrolls, doing whatever it takes to reduce the onerous, economy-killing Obamacare mandate from destroying their businesses. Recently, I called employer-sponsored healthcare a mythical unicorn of the past, as something that was once as ubiquitous as ice cream in July is becoming as rare as a perfect diamond. Heck, a friend of mine is a longtime pilot for United Continental, and even he said he pays significant amounts toward his supposedly employee-sponsored healthcare plan. For number 4, there's no way to disguise getting this one wrong. Not that in the big picture it had any real impact on precious metal prices, which have been so viciously suppressed for the past 3 years. Their historic correlations with essentially all asset classes have been temporarily eliminated, which is that gasoline prices would resume their historic march to record levels. Well, U.S. gasoline prices were $3.30 per gallon when I wrote it in January, and did reach as high as $3.65 per gallon as recently as July, compared to the all-time high of just over $4 a gallon from 2008. Before the crude oil market topped, with gasoline following close behind. Of course, despite the global carnage, the incredible, coincident collapse of countless currencies, which I've deemed the single most precious metal bullish factor imaginable, has caused the gasoline prices on a worldwide basis, the declines to be far more muted. Which brings me to prediction number 5, which could not have been more spot on or important, that multiple currencies will experience dramatic declines relative to the dollar. As longtime readers and listeners know, I don't believe it possible for the dollar to materially plunge against other currencies, as given its, for now, reserve currency status, any global economic panic will cause capital flight into it. This is what occurred in 2008 and what is occurring now. In fact, care of the massive inflation exported by the Fed's QE and ZERP efforts since 2008, the global economy is in far worse shape than ever before. Thus, the capital flight to liquidity has been even more powerful today than then, notwithstanding the PPT's maniacal stock market support, yielding a massive upside breakout of the dollar and Treasury bonds toward their all-time highs. Of course, the unintended consequences of such financial deformation will be catastrophic, as the final currency war expands and currencies continue to serially collapse. Next up, 2014 prediction number 6, which was also spot on, i.e., social unrest will expand. Frankly, that might be the understatement of a lifetime, given historic levels of unrest in all 4 corners of the globe, from Turkey to Brazil, Argentina, Thailand, the Ukraine, Greece, and Italy. Frankly, this outbreak of outrage is gaining a life of its own, and not just by the sword, but the pen as well. To that end, I wrote 3 years ago of the likelihood of massive global secession movements, in an article called Unprecedented. However, even I was caught off guard by the spate of referendums and elections that have been called this fall alone, starting with Scotland, which nearly seceded from the UK. Actually, in hindsight, they're lucky they didn't, given that the majority of North Sea oil production is in Scottish territory. Remember, the price of oil was close to $100 a barrel when they had the referendum. Next up, we had Catalonia, which voted 81% to 4% to secede from Spain and take with it 25% of Spain's tax revenues. Spain's government at the last second declared the vote unconstitutional, but trust me, as Europe implodes further in 2015, the movement to make it constitutional will only gain strength, as will the as yet informal interest in the historic city of Venice seceding from Italy, which likely will burst onto the geopolitical scene in 2015. Then, of course, were last week's snap elections in Japan and Greece, the former of which sentenced the clueless Japanese citizens to death by hyperinflation. Not that any other outcome was ever a possibility for the land of the setting sun. As for the latter, when the last of three such elections is held December 29th, Greece will most likely have chosen to hold a new presidential election early next year, in which the aforementioned anti-austerity Syriza party will likely win. Of course, anti-austerity is simply a euphemism for pro-default and anti-euro, and thus, if Syriza does in fact win, there's a good chance the euro is destroyed by a new pig's crisis, which even whatever it takes measures won't be able to reverse. And oh yeah, how can I have forgotten the Save Our Swiss Gold referendum, which frankly would have likely passed if not for the aforementioned historic central bank propaganda / market manipulation campaign. Next up, 2014 prediction number 7, that the gap between paper and physical gold and silver prices will expand. This one is the most difficult to gauge, as despite record 2014 physical demand for both metals, as exemplified by today's news that India imported such massive quantities of silver during November, irrespective of the 10% tariff still in place, that 2013's record Indian imports will likely be bested by 20 to 25% this year. At times during the year, we've seen physical premiums expand, and certainly plunging inventories and historic backwardation signal extreme tightness in physical markets, particularly for those seeking size purchases. However, for the average retail investor, premiums remain largely normal for now, which is why buying at today's historically depressed prices, well below the cost of production, appears to be a no-brainer. For 2014 prediction number 8, I expected the glaring weakness in true U.S. unemployment to become widely understood. Well, said glaring weakness couldn't be more obvious, and referring to my previous prediction, no doubt the gap between official employment data and economic reality has never been wider, with the official unemployment rate falling from 7.0% to 5.8%, whilst the labor participation rate has not budged from its 38-year low of 62.8%. Whether it's widely understood yet is debatable. However, based on the dramatic increase in MSM articles questioning the government's employment propaganda, I'm guessing this prediction is pretty darn close to fruition. And let's not forget that Janet Yellen's ambiguous phrase regarding the significant underutilization of labor resources remains squarely amidst the FOMC's recent policy statements. 2014 prediction number 9 was an interesting one, that interest in alternative currencies will expand worldwide. And by alternative currencies, I was of course referring to Bitcoin as much as gold and silver. Please note, I never predicted alternative currencies would definitely rise in 2014, only that, quote, interest would increase as fiat currencies were debauched. As for precious metals, cartel suppression was the entire story of the year, amidst historically bullish fundamentals and record physical demand. And as for Bitcoin, which in last year's Is Bitcoin Money article, I forcefully stated my belief it can never replace gold and silver, the February bankruptcy of the Mt. Gox exchange was a Bitcoin black swan that could never have been foreseen, and frankly, may well end the Bitcoin phenomenon permanently. And if so, good riddance. Last but not least, my final 2014 prediction was decidedly wrong, that the gold-silver ratio would decline. As noted earlier, most of my predictive failures this year were principally due to market manipulation, and in this case, it was the only reason, as amidst record physical silver demand, which increased at a far greater rate than gold, and a silver mining industry on the verge of collapse, per yesterday's article, a major silver shortage must and will occur, The gold-silver ratio increased from 61 to 1 a year ago to an incredible 75 to 1 today, barely below the 81 to 1 ratio witnessed at the height of the 2008 crisis. For the umpteenth time, I cannot emphasize enough that due to its surging demand, minuscule inventories, and collapsing production outlook, silver is the Achilles heel of the financial world, and thus the powers that be have done everything in their power to delay the inevitable silver explosion, which frankly, in and of itself, could destroy them. Okay, that's enough for now, as it's nearly 7 p.m. Monday night and I'm still writing. After getting a good night's sleep, I'll resume tomorrow with my 2015 predictions. Wow, that was quick. It's already Tuesday morning, and given gold's 352nd capping in the past 401 openings of the ultra-thin London pre-market session at 2:15 a.m. Eastern Standard Time, it appears quite clear that barring a powerful news event, the cartel is intent on the ultimate financial suicide, i.e., allowing gold and silver prices to close the year at such catastrophically low levels, it will likely set off a chain reaction of mining losses, write-offs, and mergers that will all but guarantee a production collapse in the coming years. But hey, no one ever called these people smart, just powerful, sort of like Dr. Evil in Austin Powers, who against his son's advice to shoot his enemies on sight, he elects to put them in an easily escapable trap whilst leaving the room under the assumption they wouldn't. Anyhow, the only overnight news during this Christmas shortened week, which in centuries past represented goodwill and a lack of angst, was the second failed Greek parliamentary vote, with number 3 set for Monday the 29th. If a consensus of 200 doesn't agree to the ruling New Democracy Party's recommendation for a new president, a snap election will be held in early 2015, which will likely pave the way for the anti-austerity Syriza Party to initiate the long-dreaded, but Miles Franklin blog guaranteed, Grexit from the euro currency, and potentially default on its 400 billion euros of debt. And oh yeah, 2 other pieces of news this morning, this time from the recovering states of America, starting with publication of 2014 movie box office numbers. At drumroll please, the lowest inflation-adjusted level since the year 2000. Yes, the lowest movie attendance in 14 years. And secondly, November durable goods orders just came out at negative 0.7% versus the expectation of a positive 3.1%. As yet again, any and all real economic data points to outright recession. But don't worry, the Fed has no fears of trivial factors like recessions, as according to Whirlybird Janet, when the PPT's equity goosing bazooka sits behind her, all such issues are transitory. Okay, and now for the news you've been waiting for, I think, regarding what I think will occur in 2015. Well, let's just start by saying, per my 2014 predictions, that no one knows how the worm will truly turn. Moreover, when discussing historically rigged financial markets, it's even more difficult to ascertain, although fortunately for precious metal investors, the more the cartel suppresses paper prices, the more rapidly they set the stage for their inevitable demise in the physical markets. And on that note, here are my top predictions for 2015. Number 1, Retail Armageddon. In the next few weeks, it is all but certain that we will learn of not only the weakest holiday sales since the 2008 financial crisis, perhaps equally bad, but utterly catastrophic corporate earnings across the retail sector. Retail sales, particularly on an inflation-adjusted level, have been as bad as I can remember in my lifetime. And now that the expanding recession meets headlong with the dramatic market share gains of online versus brick-and-mortar purchases, let alone the looming specter of Obamacare, 2015 may well yield an utter explosion of retail store closures and layoffs, which, by the way, will have the ancillary consequence of collapsing commercial property values. And better yet, the resultant collapse of federal tax revenues may well usher in, at the least, active congressional debate on online sales taxes. If 2015 is indeed the year this occurs, it will likely have the same devastating impact on U.S. economic activity as Japan's catastrophic sales tax increase 8 months ago. Number 2, return of the pigs. If Greek snap elections do in fact result in Syriza taking control, it's all but certain that the last remnants of Draghi's whatever it takes hopium will nearly instantaneously dissolve, as fears of a splitting of the euro currency and perhaps the eurozone itself will likely yield exploding bond yields in not only the pigs, but countless other fringe nations that rely on promises of ECB QE to stay afloat. However, no amount of QE, which assuredly the ECB and the SNB, given the franc suicidal peg to the euro, would ramp up to epic levels, but none of that will be able to assuage fears of a Greek debt default, which in turn would cause the same type of horrifying debt and derivative chain reaction that nearly took down the Eurozone a mere 3 years ago. Under such circumstances, take a wild guess what assets fearful Europeans will flock to. And by the way, isn't it nice that just last week, all 300 trillion of the U.S. banks' derivatives are now put under the umbrella of the bankrupt FDIC program? Number 3, first signs of yen hyperinflation. The final currency war I wrote of 2 years ago is in full bloom, and frankly, only the Fed's inevitable QE4 announcement lies between today's fragile environment of government-supported stock and bond markets and all-out financial panic. However, as the global economy continues to relentlessly decline under the hopeless, rapidly expanding debt burden caused by 44 years of history's largest fiat Ponzi scheme, Whirlybird Janet will be forced to make the Yellen reversal I first wrote of this fall. And when she does, the global printing presses will be forced into hyperdrive, which of course will have the greatest detrimental impact on the nations with the highest debts, the weakest demographics, and the most suicidal central banks, led of course by the land of the setting sun. To that end, I have written all year of my expectation that Japan will be the first world economy to experience hyperinflation. And when not only the Fed, but the ECB, PBOC, and other central banks are aggressively debauching their currencies as well, Shinzo Abe will decidedly use his newly secured mandate to expand the money supply further, possibly depressing the yen exchange rate to 200 per dollar or higher. If such a deadly chain of events in fact commences, the odds of a loss of confidence in all things Japan would rocket to the stratosphere. Number 4, oil collapse contagion. I wasn't kidding when I wrote last month that 2015 shale oil equals 2008 subprime mortgages, as in the U.S. alone, an incredible $500 billion of junk bonds and leveraged loans were used to finance the shale bubble. Given my decade of experience as an energy analyst, I warned in April 2013 that shale drilling possessed all the hallmarks of disaster, given its extremely high depletion rates, capital expenditure requirements, and break-even crude oil price requirements. However, even I could not have imagined that Wall Street would subsequently do the exact same thing with marginal shale oil drillers as they did with marginal home buyers in the mid-2000s, i.e., utilizing the Fed's unending ZIRP policy to finance anything with a pulse. And now that a rapidly expanding economic collapse has left the global energy market hopelessly out of balance, with Saudi Arabia last month declaring, for all intents and purposes, all-out war on high-cost energy production, it's all but certain the impact on the U.S. shale oil industry will be catastrophic. Already, said bonds, and stocks for that matter, are in free fall, and now that rig counts have started to plunge, not only will mass defaults be a major threat to financial stability, but so will the evaporation of E&P capital spending, which, by the way, accounts for a whopping 1/3 of all S&P 500 corporate expenditures. Think about it. Not only has energy become the largest component of the U.S. high-yield bond market, but it is the only industry that has produced net positive job growth since the 2008 financial crisis. Number 5, mining industry paralysis. Perhaps paralysis is the wrong way to describe it, as 15 years of stock price suppression caused capital availability to mining companies to evaporate years ago. Heck, it was already gone when I left the mining industry in 2011. And since then, prices of both the metals and mining stocks have precipitously plunged. Nary an executive of the industry, outside Keith Neumeyer of First Majestic perhaps, has done a thing to counter the manipulation that has all but destroyed precious metal mining, nor for that matter supposed trade groups like the miner-funded World Gold Council and Silver Institute. Thus, once the catastrophic year-end losses, reserve write-downs, and capital expenditure reductions are completed, I fully expect essentially all the major miners to start merging in earnest, starting with the world's 2 largest gold miners, Barrick and Newmont. And no, I don't expect mining stock investors to make significant profits in the process, as mergers catalyzed by mutual distress typically do not entail significant premiums. When all is said and done, to simply survive, the industry will need to do what the oil industry did when oil prices plunged albeit temporarily in 1998, which is to cut what's still left of overhead and capex to the bone, causing an industry paralysis that will likely last years. Both metals will likely experience dramatic production declines over the next 3 to 5 years. And in the case of silver, particularly if global recession causes base metal prices to remain depressed, a plunge of as much as 50% in silver production is not out of the question. Per the conclusions of October's Miles Franklin Silver All-Star Panel webinar, which you can find online for free. Number 6, falling commodity prices. Outside outright hyperinflation, it is difficult to envision rising prices of any industrial commodities amidst an expanding global recession, much less one characterized by the largest debt loads in global history and accelerating currency wars. Supply and demand for nearly all commodities is way out of balance, not just due to weak economic activity, but the massive overcapacity caused by years of the misallocation and abuse of zero-cost central bank financing. Of course, certain sectors will not have the same type of pressures as others, especially if for instance, Brazilian drought continues, but for the most part, especially with industrial commodity prices, the trend will be down for as long as the eye can see. Number 7, collapse in currencies. As I predicted last year, the dollar will not only rise against fringe currencies, but even broadly used ones like the euro, yen, and pound. Not because of U.S. economic strength, but as in 2008, because during times of crisis, global capital always gravitates to the most liquid assets. Throw in the additional issue of literally dozens of nations depending heavily on commodity exports to fund their governments, and it's not difficult to envision ruble crises breaking out the world round. Of course, no one will be injured more by a dollar surge than corporate America, which will lobby to the death for the Fed to step up QE to enable the reporting of higher, quote, profits for the 1% that benefit from their policies. Number 8, revenge of the people. Again, even I was taken aback by the rapid-fire series of anti-government referendums in the year's final 4 months, from Scotland to Catalonia to Switzerland, Japan, and Greece. However, given the expanding pace of global economic contraction, I expect revolutionary movements, in most cases peaceful, to explode upon the scene in 2015, even in places as civilized as France and Italy. At some point, one or more of these referendums will have cataclysmic global ramifications, be they in Greece or elsewhere. Number 9, the reemergence of real money. Per last week's article of the same title, undoubtedly more and more of the world's 7+ billion denizens will grow fearful of the dying fiat regime, causing still greater acceptance of gold and silver as not only wealth protection tools, but the real money they have always been. Per last week's article titled The End of the Gold Bear Market, with bear market in quotes because it was solely due to manipulation, the aforementioned currency collapse has caused gold to already rise substantially in most currencies, which is probably why gold and silver experienced record global demand in both 2013 and 2014. However, as the last remaining vestiges of stability are sloughed off, surging demand could potentially break the cartel's vice-like hold of the past 3 years, triggering the inevitable silver shortage I wrote of yesterday. Under such circumstances, precious metals' long dormant, central bank suppressed role in the monetary world will inevitably reemerge as the once and future king they've always been. To that end, it's no surprise that Germany and Holland, nearly Switzerland, and likely Belgium, Austria, and France have either demanded repatriation of national gold assets or plan to do so shortly. And then, of course, there's the Chinese and Russians, who, when all is said and done, will likely be revealed as the world's 2 largest physical gold holders. Well, hopefully that's a good amount to digest over the holiday week. I wish I had something more positive to say, but my reputation has been developed over the past decade by speaking the truth, and to that end, my message of wealth protection with gold and silver, which I have personally heeded since 2002, has never been more urgent. Have a fantastic holiday from the Miles Franklin blog. And when the calendar turns next week, if you do decide to protect your assets with precious metals, we hope you'll call us at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thank you.